Guys, you're not going to believe this. I just came from the year 2030 to see how many cars Tesla is selling and where the Tesla stock price is. I got some good news and I got some bad news. Hit the like button and I'll start off with the good news. Elon Musk said Tesla will make about 20 million electric vehicles by the year 2030, a lot more than the 500,000 that they made in 2020. So have they achieved that goal? It's way better than that. In 2021, the passenger car market is expected to be about 70 million units. And in 2030, it's about the same because of ride sharing and not a lot of growth in passenger cars. But Tesla is 100% of the market. They sold 70 million cars in 2030. Can you believe it? Now, the strange thing is they didn't get up to 70 million car sales in 2030 because they outpaced the competition. No, they got up there because the world UN emperor, the first one, Greta Thunberg, made a decree that all other car makers will not produce any more cars, and Tesla has the whole market to itself. And so Tesla is 100% of the car market, selling every single new car in 2030, 70 million cars a year. So now that we don't have to do any more projections about how many cars they might sell, or 10 million or 20 million, we know they're selling all the cars. But let's see what that's going to do to their stock price in 2030. So here's the passenger cars sold in 2020, the dip in 2020, but it's expected to be 70 million in 2021 and about the same in 2030. And before all the other car manufacturers were shut down, this is their market share by company in 2019. So you see Toyota was 10%, Volkswagen was 7%, Ford was 5%, and Tesla is not even on here because it was about 0.8% of the total market. And the revenue in the passenger car market in 2021 is going to be $1.645 trillion, which is the same as it's going to be in 2030. So if you take the $1.645 trillion in sales and divide it by 70 million cars sold in 2030, that makes every car sold on average to be $23,500. So how much profit can Tesla make on a car like that if they own the whole car market in 2030? Let's take a look at that. Now, to give you an idea of where Tesla stands now, selling only 500,000 cars a year compared to Toyota's 10 million cars a year, their market cap is 800 billion according to this graphic. The stock has fallen recently and now it's more like 700 billion to Toyota's 200 billion. And all the rest of the car companies, these circles represent how big they are compared to Tesla. Let's take a look at this graphic. Here's Tesla at 795 billion. Here is Toyota at 207 billion. And here's the rest of all the other car companies. And Tesla is worth more than about 5 or 6 of them, the biggest ones combined. So when you're a luxury car maker like Tesla selling 500,000 cars a year, you can have a lot bigger margins. But when you get to a big scale and you become 10 million, 20 million units a year, or the whole market in this case, what do your margins look like? So here we see that Ferrari's profits per unit delivered was 86,000 euros, and Tesla, not as much. But comparing Ferrari to the profit of other car manufacturers, you see how many cars they have to sell to equal the profit of one Ferrari sold. And so BMW has to sell 30 cars, Toyota has to sell 44 cars, which means Toyota's profit is about $2,000 per car or something along that line. And it goes down the line. GM has to sell 136 cars to make the same amount of profit as Ferraris. And that's the problem when you get to be a mass manufacturer. Your profits go down like crazy because not everybody can afford a luxury car. You have to sell a cheaper car that people can afford. And that will be Tesla's problem selling 70 million cars a year. So let's see what their profits are going to look like. Now, if you've only been looking at the stocks of electric car companies, you may not know that traditional car companies, their profits are very low and their PE ratios are also very low historically. So let's take a look at the revenue, sales, and the net income profit of these big companies along with Tesla and see what their net profit percentage is. So Toyota is $285 billion in revenue. Their net income is about 20 billion. And so their net profit is only like 7%. And it gets worse. Volkswagen's 2.3%. Even Mercedes is only 2.6% net profit on their sales. And even Tesla, which has about $32 billion in sales, has net income of $700 million, and that's also like 2.3% net profit on sales. So if Tesla has the whole market, but they have to do mass market and sell lower priced cars, and which means lower profit percentages, is their stock price going to hold up? Is it going to be lower or is it going to be higher? I don't know if you know this, but right now, Tesla PE, the price to earnings ratio, is about 1100 compared to the big auto manufacturers are anywhere from like 8 to 15 PE. And what that means is the price to earnings ratio means how many years it takes to get your money back from earnings. So if you have a 1100 PE, that means you're paying $1,100 for $1 in earnings. And so if you bought the whole company, it would take you 1,100 years to make your money back based on the current earnings. Whereas something like Toyota, it would take you something like 12 years at a 12 PE to get your money back, or that you're paying $12 for $1 per year in earnings. So seeing that the net profit in the auto industry is really low when you're in the mass market and you're selling millions and millions of cars, let's run through a few scenarios of Tesla possibilities with different net profit percentages and different PE ratios and different car sale numbers. So let's say that they don't sell 70 million in 2030. Let's say they sell 20 million like Elon Musk said, or let's see what happens if they don't even do that and they just sell 5 million, which is still 10 times more than they're currently selling right now. So let's look at a few different scenarios here. The first one is going to be a net profit of 10% and at different sales levels of 70 million cars, meaning 100% of the total car market in the world for passenger cars, 20 million cars, which is what Elon Musk said that they will sell in 2030, and 5 million cars a year, which is still 10 times more than they sell now. And so the most rosy projections, okay, so the revenue, 1.65 trillion, 10% profit would be 165 billion in profit. At a PE of 10, the stock price would be 1721. PE of 15, it would be 2581. And a PE of 25, which is like what the S&P 500 average is right now, would be $4,300 stock price current from where it is now, which is like 6 times greater than where it is now. Just because the S&P is average PE is 25 doesn't mean that car manufacturers are at a 25 PE. They are much lower. So this is the most rosiest projection you can get. And the same net profit of 10% at 5 million units and a PE of 25 is only $305. At a more likely PE of 10 is $122 a share for Tesla 10 years from now. Now, what if their profit is more like 5%, which is still almost twice as much as the Mercedes-Benz profit and most car manufacturers that I showed you on that list? Well, let's see. If they had the whole car market, 70 million cars, their profit would be 82 billion. At a PE of 10, their stock price would be $860. At a PE of 25, it would be 2151. But now let's look at the so-called worst case scenario out of these choices here. If their net profit is 5%, which is still pretty high, and they sell 5 million units, which is still 10 times more than they currently sell, their net profit will be 5.85 billion, and at a PE of 10, which is auto industry average right about, the stock would be $61 a share. Even at a PE of 25, their stock price would be $153. So depending on how many cars you think Tesla will sell, what their profit margin is going to be, and what the PE that the market gives them is going to be, their stock price could be anywhere from higher from here to a lot lower, like 90% lower. And just to let you know that, like I said, Tesla PE is like 1100. If it was similar to what the S&P 500 is of 25, the stock price would be 44 times lower, or about $16 a share right now. Now, this is the point where all of the Tesla bulls come out and say, Tesla PE is never going to go lower than 1100. They're just going to keep selling cars, and the market's still going to give them that high PE because their growth is infinite, and it's a new market, it's a new technology, and they're going to grow forever and ever and ever. And this time is different, right? For those of you that don't remember, in 1990s, late 1990s, Cisco was the Tesla of that time. They had the new technology for the internet. They made the routers. The internet was growing exponentially. There was no end in sight to the growth. And so they were just going to grow their earnings forever. And if you told anybody anything different, they would probably get mad at you and curse you out and say you don't know what you're talking about. One other thing is that Cisco was the first company that was expected to be the first $1 trillion market cap company. And this was back in like 1999. And they made it to about $500 billion market cap. So let's go take a look back and see where Cisco was. And at their peak, their PE was only like 250. So 1/4 as high as Tesla is today. Let's see what happened to Cisco. So here in April of 2000, Cisco's PE was 251. And people said that this was going to go on forever. And they were never going to be the average of the S&P 500 PE ratio. Well, look what happened to them. Okay, here they are somewhere along 17, 20, something like the S&P 500, because companies don't grow at hundreds of percent a year forever. Trees don't grow to the sky. That goes for all companies, whether Cisco or Tesla or whatever. Now, you may be thinking, well, that happened to Cisco because probably their earnings went down, right? Well, here's their earnings per share in 2000, 39 cents a share. And yes, it did dip after the internet bubble, but now here they're $1.92, and currently they're like $2.40 or something like that. So they've grown something like 6 times since 2000. How come the stock price hasn't grown? So here's the stock price of Cisco. It was about $80 in 2000, and here we are 21 years later, and it still hasn't recovered its previous high when everybody thought that it was just going to grow and grow forever. And here's a look at their market cap in 2000. They were $540 billion, and everybody assumed that they were going to be the first $1 trillion company. And here we are 21 years later, and their market cap is less than half of that. So guys, no matter how much of a rosy projection you assign to Tesla in the future, the stock is more than priced to perfection. And eventually the air is going to come out of it because people lose interest in it when it's not going up 50%, 100% a year. You see that it already has lost a lot of interest and about $200 off the price in the last few weeks, because people are more interested in GameStop and small stocks that go up quicker than Tesla has been going up recently. Tesla will not grow forever, and when it does come down and the PE comes down, that stock price is going to fall a lot, even if they're producing more cars, even if they're producing more revenue like Cisco did and more earnings per share, because the PE is just too ridiculous right now because everybody is overly optimistic about it. So history doesn't repeat itself, but it rhymes. You know, now that I think about it, I should go back to 1999 and warn all the Cisco stockholders who are bullish on Cisco at a PE of 250 and think it's just going to keep growing forever. I'm sure after I warn them, they will thank me for saving them a whole lot of money. Let me go do that right now. Oh man, those Cisco investors didn't take too kindly to me warning them about the stock being overpriced. Well, I'm sure Tesla investors are different, right? Thanks for watching, guys. I'm going to go clean up. I'll see you in the next one.